What is behind the recent slowdown? Hyun Song-shin, economic advisor and head of research, presentation at the Public Finance Dialogue. Workshop arranged by German Federal Ministry of Finance and Center for European Economic Research, ZEW, Berlin. May 14, 2019. Manufacturing and trade have slowed in recent months. Even as domestic consumption has remained relatively more resilient, underpinned by the services sector and strong employment. What explains the slowdown in manufacturing and trade, even as the services sector and employment remain strong? A brief history. Some historical perspective is useful. In seeking to understand the slowdown in manufacturing, a good starting point is to look at the current state of world trade and GVCs. The graph shows a striking pattern. Crucially, the CGFS found that around 80% of bank trade financing was denominated in US dollars. Reflecting the prevalence of dollar invoicing in world trade. The striking inverse relationship between world trade and the strength of the dollar is a correlation. And we should not rush to infer a direct causal relationship. Implications for policy. Financing of working capital to sustain. Manufacturing and trade shines a light on the role of the banking sector. Once the growth of manufacturing and trade through more intensive use of GVCs has run its course, relying excessively on manufacturing and goods trade may be setting the global economy up for disappointment. Exchange Rates and Monetary Policy Frameworks in Emerging Market Economies. Lecture by Mr. Augustin Carstens. General Manager of the BIS, at the London School of Economics, London, May 2, 2019. Introduction. Good afternoon. Monetary policy frameworks are being actively discussed again as central banks around the world attempt to chart their course in the unfamiliar post-crisis economic waters. Central banks find themselves in similar circumstances. These flows act through different channels and therefore have different consequences. Thus, in the course of my lecture today, I will concentrate on how central banks have fared in the post-crisis era. And what challenges they face in shaping the contours of a monetary policy framework that can serve them well in the coming years. In some respects, EMs have had a head start in charting their monetary policy strategies as they revamped their policy frameworks in the wake of the severe financial crises that hit them in the 1990s. But reality reflects the importance of the exchange rate. Challenges posed by swings in exchange rates. Why do central banks care so much about the exchange rate? At a basic level, it's because the exchange rate is a core determinant of the nominal anchor in a small open economy. Exchange rates and the nominal anchor. Exchange rates impact domestic inflation through their effect on the price of tradables. To anchor inflation expectations in the face of destabilizing domestic currency depreciations. Central banks tend to tighten their monetary policy stance, usually by adjusting a short-term reference interest rate. In circumstances of extreme market volatility though, traditional monetary policy adjustment through short-term interest rates might not be enough to preserve the anchoring of inflation expectations. So, while exchange rate pass-through has declined, it would be too complacent of us to assume that inflation has been vanquished. Before we delve deeper into the discussion about the appropriate role of the exchange rate in monetary frameworks, it is important to understand in greater detail the main avenues through which exchange rate fluctuations work across different layers of the economy. Exchange rates and export volumes. Let me start with exports. The role of trade finance has increased as global value chains, GVCs, have lengthened. Requiring greater financial resources to underpin their expansion. Exchange rates and domestic economic activity and financial conditions in EMs. The exchange rate also affects domestic economic activity through financial conditions, further complicating the central bank's task. Over the past 2 decades, the stock of foreign currency debt of EMs has surged. Driven in particular by the non-financial corporate sector. And in many cases it has not been matched with FX assets and revenues, giving rise to currency mismatches. Such currency mismatches on borrower balance sheets make financial conditions a function of the exchange rate. Even in the absence of currency mismatches on borrower balance sheets, exchange rate swings influence domestic financial conditions. Taking account of exchange rates in monetary policy, conduct the link between exchange rates and domestic financial conditions and the weakening of the traditional trade channel have important implications for monetary policy. Moreover, thanks to the presence of powerful financial channels, exchange rate fluctuations push inflation and debt in opposite directions. Potentially raising an intertemporal trade-off for the central bank in the pursuit of price stability. In the face of these difficult trade-offs, traditional monetary policy response. Through short-term interest rates runs the risk of falling short of what is needed. First, through its effect on the exchange rate, it can directly counteract exchange rate. Swings that would have undesired effects on the inflation rate and on the real economy. Second, the accumulation of reserves has macroprudential-like features. At the same time, stereo-leased FX intervention counteracts the mutually reinforcing feedback loop. Between exchange rate appreciation and capital inflows that fuels domestic credit creation. The analogy with macroprudential instruments such as minimum loan-to-value ratios or the counter-cyclical capital buffer is obvious. Thus, while national foreign reserves are an important element of the global financial safety net, they are quite costly and, also for that reason, will always be limited. Targeted policy measures besides FX intervention, EM central banks have also resorted. To traditional macroprudential tools and, although less frequently, to non-orthodox. Balance sheet policies to deal with the challenges from exchange rate swings. The targeted nature of macroprudential tools has the advantage of reduced collateral damage if imbalances and vulnerabilities are concentrated in a specific segment of the financial sector. In such situations, central banks may instead resort to non-orthodox balance sheet policies. Central banks could also prevent capital flows, and thus exchange rate pressures. By facilitating the duration adjustment of portfolios in times of stress. Monetary policy frameworks, which way forward? What do all these considerations mean for monetary policy frameworks in EMS? The textbook version of the inflation targeting framework. Which prescribes pursuing inflation stability with floating exchange rates through adjustments of a short-term interest rate. Is obviously too narrow for central banks. Central banks have risen to this challenge through their innovative use of additional policy instruments. Going forward, central banks will need to further develop their toolbox. For dealing with the challenges of exchange rate and capital flow gyrations. Central banks also need to contend with how to address the intertemporal trade-offs that exchange rate fluctuations have given rise to. Finally, policymakers need to consider measures to reduce the vulnerability of their countries to exchange rate gyrations. Thank you very much. Global imbalances and the international footprint of firms, what role for exchange rates? Hyun Song Shin, one economic advisor and head of research, Joint G20/IMF Seminar on Global Imbalances, Washington, D.C. April 10, 2019. Leading firms straddle national boundaries. By the way, please do not confuse corporate saving with corporate cash holding. Exchange rates and financial conditions. Trade in manufactured goods powered the increase in global trade. These insights shed some light on the recent slowdown in manufacturing and trade. The new role of central banks. Speech by Mr. Augustin Carstens, General Manager of the BIS. To the Financial Stability Institute's 20th Anniversary Conference, a cross-sectoral reflection on the past. And looking ahead to the future, Basel, March 12, 2019. Introduction. Ladies and gentlemen, good morning. It is a pleasure to open this conference celebrating the 20th anniversary of the FSI. The establishment of the FSI in 1999 was the result of a joint proposal made by the BIS, and the Basel Committee on Banking Supervision in response to G7 leaders' call to strengthen financial stability worldwide after several crises that took place earlier that decade. "20 years later, much has happened that has affected the landscape. Of the global financial system and shaped the FSI that we have today. This trend shows how potential synergies across policy objectives. Have gained relevance in the design of the institutional architecture. Let me touch upon those issues in the rest of this talk.